Collaborating together with a group of industry-leading advisors, we held Buzzcot's first Family Office Services Roundtable to discuss the latest considerations for wealthy families from a tax, investment, legal and property perspective. We kicked off with a discussion around the impact of COVID-19 on businesses and our clients, from borrowing trends and investment portfolios to succession planning and economic recovery. After that, we delved into the impact of potential tax changes and key considerations for trusts and beneficiaries. To round off the session, we explored growth and investment opportunities and the importance of building relationships in the new, more virtual world. Watch the full recording now and be sure to get in touch for more information on how these factors may impact you and the opportunities available.
Let me introduce everyone. First, we have Mark Fleming, who's a Senior Private Client Trust Director at JTC, which is the Jersey Trust Company, and based in Jersey. Kunal Weiss is a partner at Taylor Wessex, specialising in private client. And we've got Stuart Richardson, who's the Investment Director at Tilney. We've got Ollie Spry, who's a Private Banking Director at EFG. And finally, but not least, Guy Beach, who has worked for many years in investment banking and looks after a number of family offices, both co-investing and investing on their behalf. Let's talk about COVID. I think COVID's the big elephant in the room, and it will be for quite a while, I think. So what trends are emerging from clients and from our businesses, and what are the challenges that face on the horizon?
I think initially, turning to clients for a minute or two, the clients we had, when kind of February, March came, it was really around assessing how COVID was going to impact on them, their families, and any kind of underlying businesses they had. So there was a kind of general sense that people were taking some time to really kind of see what it is we're kind of dealing with, and what steps, if any, need to be taken to, I guess, kind of hedge against any kind of damage that could be done. So let's say if you had interest in a hotel business, how are you going to plan around that? What do you do around your investable assets? What are the right assets to be, and do you increase your allocations to gold? So there's quite a lot of those conversations. So to clients, spend a lot of time kind of thinking about that, but also trying to kind of then move relatively quickly to position themselves in the right way. And I think they've had to kind of keep doing that as things have evolved. So you've had to be flexible throughout. We've seen, I guess, that period where there was some semblance of clients doing that, and also us as employees and working for firms, where we had to kind of get on top of how to actually interact with one another through the new mediums. But I think, from my perspective, we were able to do that quickly. Teams was a kind of godsend. We got kind of Zoom in all these different mediums. You got quickly up to speed with them. Been lucky in Jersey that there's been probably loosened a little bit quicker than in the UK, so we were able to get back into to offices. But equally, we're still kind of in a state where we're video calls with clients and advisors. But I would say that people are more kind of agreeable to doing that, because they have that kind of time on their side to do so.
One of the things that I appreciate, when Jersey, I think about 3 or 4 years ago, introduced some real high-speed internet access into the island, and was probably one of the lead and probably one of the best ones in the Europe.
Yeah.
And that probably helped their process in terms of communicating with clients. I know one of the things that when I've spoken to all trustees around the world, one thing Jersey and Guernsey have been recognised for is the speed they dealt with the crisis, the backup plans they had, that they could keep in contact with their clients pretty much immediately, and that continuity of service, which also then demonstrates how trustees are important in guiding clients through that process, but also having access to them. Whereas in some jurisdictions, you couldn't even get hold of people for weeks after the initial COVID breakout.
Yeah, and I think that was, I think you're right. There was one outage actually, but it was on a Sunday, so that was timed quite well. But we have, considering how many people are kind of working from home, the infrastructure's held up really well.
So Stuart, Mark was talking about the investment side of things, and portfolios potentially being adjusted for the COVID pandemic over the period as we're going through it. Have you seen a similar sort of thing happening with your portfolios?
Yes, I think there's definitely been I think the sort of first wave of sort of thinking about COVID, you have to at the highest level try and assess the risk in client portfolios. And for us that was pretty easy. We run All of our equity exposure is very high quality, and we tend to very much shy away from cyclical, leveraged sort of sectors and so on. Just prior to lockdown, probably about 2 weeks prior to lockdown, you might remember that the Saudis came out with an announcement that basically said that they were going to flood the market with as much oil as they could get their hands on. And when you're sort of considering both the potential sort of I guess building impact of COVID in early March, together with that weekend announcement from the Saudis, it was pretty clear to me that the sort of disinflationary or deflationary thrust in markets and the global economy was a very, very real risk. And so what we did at the time, so before lockdown, we actually sold all of our non-government bond exposure, remembering back to the times in 2008 when corporate bonds are just so illiquid and you never quite know what the market's going to do to you, but you know you can lose a lot of money, and when the yields are sort of 1%, maybe 2%, you have a very poor reward compared to the potential risk when you go into a deflationary environment. So actually we had a lot of conversation with clients explaining what we were doing on both fixed income and equity side, and also a bit of hand holding. But really for us, there's coming in towards the end of March, as markets had been falling pretty quickly, the one thing that we were very clear about in our philosophy and strategy, but also articulating to clients, was let's not get confused between the COVID headlines, which are obviously coming at us all day, every day, but we had to be aware of what the reaction function was of policymakers, both government fiscal policy and in particular central bank policies. So really the first level effect was obviously risk analysis and make sure that we're positioned properly. Secondly, reacting to the policy response, which is to us was the most important thing coming out of Q1. But the bigger picture moving forward is very much what's the sort of future going to hold in terms of macro forces at hand, and how do you position portfolios for those?
Thanks, Joe. That's very helpful. Ollie, can I ask you a question regarding property? Because obviously where I live in northwest London, the property prices have just escalated and gone out of control. We're looking to buy somewhere and trying to find somewhere to buy, but there's so many buyers out there in the market at the moment with interest rates where they are at the moment, and also SDL. Are you seeing similar trends in terms of borrowing at your bank and the availability of borrowing? Because the other issue I think we've had from certain estate agents is they want assurance that the borrowing is already in place, because they're worried that you make an offer, but then the borrowing falls apart because you're asking for 95% mortgage.
Absolutely. I mean, just to go back to your looking, I'm in the same boat as you. You know, I think there's been a massive sort of boom in property prices and people looking to buy property. Maybe that's partly due to a pent-up demand coming out of COVID or coming out of lockdown, and people maybe want to move out, get more space. But from private banks' perspective, and certainly from us at EFG, we are seeing a massive uptick in people looking for liquidity. I mean, I would say, you know, dealing with ultra high net worth clients, you know, our minimum loan size is around the 3 million mark. But absolutely, from a bank's perspective, we've definitely got the appetite, and we've been lending not only on real estate but other assets like portfolios as well. But I think there's no doubt about it. People want liquidity at the moment. People are looking at trying liquidity out of assets. But also, I think, as you say, I think the real estate market is having this pent-up demand boom at the moment. Whether it lasts, I'm not so sure. The end of the furlough scheme, there could be some huge unemployment numbers in the next couple of months coming out. I think in the retail market, that will affect the market, the residential property market dramatically. And I do think it will come off somewhat. But going back to sort of our type of clients that you and I and everyone else on the call look after, I think from an EFG's perspective, there's great appetite to lend against real estate in London and the home counties, and certainly with the low interest rate, a lot of our clients are taking advantage of it. And we're also definitely helping, you know, trustees out in the Channel Islands to help leverage some of their properties or help refinance some of their properties, as you said, with the current low interest rates. So I think it's a good source of business for us. EFG are particularly good at it. It's definitely one of our unique selling points. And I think liquidity management will be vital for ultra high net worth clients, depending on what sector they're in. I mean, as well, there's a lot of clients who probably will be in the hospitality sector, the restaurant, hotel sector, who might be struggling with income at the moment, and that might be an opportunity to help with liquidity. But yeah, so going back to your point about the residential property sector as a whole, there's definitely good demand out there at the moment, but I think it will tail off.
Thanks, Ollie. Kunal, what are you seeing out there from your clients? And I know you did some research that you sent over to me a few months ago about thought piece in terms of what COVID means and all the rest of it. Have your views changed since then? Have they developed since then?
I mean, I think, clients and indeed ourselves, we're all going through a journey, and the considerations which are in play as that journey progresses have been constantly evolving. And I think if you take a moment just to kind of, in terms of the piece that you mentioned, I think certainly, if you go back to March, a number of the clients that we were, in conversations with were looking to just see how the next few months pan out, just kind of take a step back, and understandably focusing their attentions more on the immediate family interests and business interests, and just effectively shoring up things. Fast forward to where we are now, there is this acceptance now that this isn't going away anytime soon. And therefore, more active planning, structuring is more of a focus. And by more active planning and structuring, I think certainly, and understandably, an area which has come at the kind of epicenter of discussions is generally succession planning and reviewing wills, reviewing lasting powers of attorney, but also making sure, and I think, sadly, people are starting to appreciate their mortality more than they perhaps were doing previously.
Absolutely.
Thinking about the fundamental points that, if they were no longer around, what is going to happen to their business? What is going to happen to their investments? What is going to happen to the structures that they've already set up? Are they robust to deal with the eventuality of, say, the matriarch or the patriarch no longer being around? So there's been a lot of time spent on reviewing those structures just to make sure they remain robust and reflect the current objectives of the family as well.
Are you also seeing people considering going non-resident now? I've certainly over the last 3 or 4 months had more people thinking about going non-resident, not just from a tax perspective, but also from a COVID perspective. Now, I think more people are thinking about security in the sense of, am I going to get infected or some harm going to come to me or my family, as opposed to looking at tax reasons for going non-resident. So that's an interesting sort of change over the last 6 months. As you say about mortality and wills, we've seen certainly an increase of people now.
Yeah, no, absolutely. I mean, in terms of looking to relocate, it's interesting because I think there's a domestic relocation aspect that's come up a lot, and that's by a number of people, appreciating that the amount of time they might be spending in the city is now reduced because of things like agile working. So certainly there is a mass uptake on clients looking to find bigger estates outside of London where they have larger gardens and can live a much more comfortable lifestyle in the event of another lockdown scenario. And interestingly, we've also found interest from abroad from clients who are looking to see the UK as being a better, notwithstanding the high COVID rates in the UK in comparison to other jurisdictions, they still find the UK as being a better place to having to, say, self-isolate or quarantine than necessarily would have been the case in other jurisdictions that they might be based in at the moment. But you're right. I mean, relocation outside of the UK is coming up. The tax point isn't one which is going away. I mean, often the discussion is with an interplay with tax planning generally. So it's effectively an exit strategy.
Yeah.
But the difficulty you have with that is that, the UK obviously isn't alone in having a fiscal deficit to try and plug. So the jurisdictions which have been increasingly popular at the moment, take Italy as a classic example, with their flat tax regime. Who knows what the position is going to be in Italy in a couple of years' time? So I think any client that's looking to move from a tax perspective certainly has to always bear in mind any planning could quickly change, the same way as the concerns are in the UK as to possible tax reform.
Guy, what are you seeing from your side with working with family offices? Are they still looking for investments? Are they still looking to co-invest, or things have dried up?
Thank you, Rakesh. Yeah, I think, we've been through very much a phony war during lockdown and the summer. And I think, again, depending on a family's assets, they've been looking to their existing investments rather than reaching out for new opportunities. And I think a word I've heard repeatedly during that period has been curating. People have been curating their existing assets, which covers perhaps a multitude of problems below the surface. But I think people are now mentally, if they're not back in the office physically, and people are now starting to look around at what they need in order to move forward. I think also partly in the knowledge that this is going to go on for a long time. It wasn't going to be over by Q4. It's going on. The world is still turning, and people need to get on with things. All family offices, as we know, are completely different in terms of their background, interests, and assets. But we are starting to see activity. I think that the virtual conversation has been hugely helpful to bring people together. I did a meeting last week which involved a family office in Germany, a family office in Mexico, a family office owned bank in Austria, a family office advisor in Madrid, and myself. And I just pale to think about the organisation that would have been required to achieve that meeting, had we not all been doing a web call. Well, I think the flip side of that is it does make physical transactions a lot harder, because you've got to get documents together, you've actually got to go and see assets sometimes before you actually execute a transaction. So I think the dialogue's there very easily, but I think implementation and deal closure is still hard in this current environment. In terms of what people I think are looking for, people are being very specific. It's very much trying to pick the winners going forward from here. And I think two things come to mind that I'm involved with at the moment. One is infrastructure with my German family office, who own an infrastructure platform in Europe. People see infrastructure as being of strategic importance going forwards towards, let's say, the end of COVID or the future of COVID, and capital raising for infrastructure products as being important. So people see that as perhaps an area of good yields, something that might be relatively secure as an investment. I think the other side of the coin at the moment is, if you look at what businesses are going to win, technology stands out above all else. And, we've seen that there's been a feeding frenzy in listed tech securities, running out of the summer. You can see that evidenced by the NASDAQ. Certainly with my involvement in venture capital, we're seeing a lot of interest now in unlisted tech businesses. I think whilst a lot of listed companies look quite expensive, unlisted tech businesses are desperate for capital, and they're prepared to offer clients good valuations in order to source that capital. The business I'm involved with, Committed Capital, they've completed 4 very successful raises during lockdown, which I think has been impressive in terms of their ability to deliver returns. But I think for the purposes of this conversation, what it does is actually evidence appetite across high net worth individuals to make selective investments in the areas that they see as being successful. I guess just linking up with some of the other previous comments, I think families are certainly a bit jittery about what's coming next from a tax regime perspective. But again, that's very country specific. Talking to my colleagues in Germany, it's off the agenda at the moment. There's an election coming in Germany, and clearly it's an issue below the surface, but no politician actually wants to vocalise about tax raises at the moment.
Thanks, Kai. From our perspective, we've been speaking to clients about the potential changes, and one of the things that we've obviously talked about quite a lot is the CGT rates being realigned with income tax rates, which should have major repercussions across the board.
Yeah, I think certainly what we found is, and what we've been encouraging is, clients who have been thinking for quite some time to take certain steps or carry out certain transactions, effectively accelerating them. What we're seeing less of, and I think is always the trickier one, is whether you take proactive steps to, for instance, rebase the value of assets in the anticipation that they could be a increase in capital gains tax at a later date. And there's always, and that's partly because there's an inevitable risk on that. As you mentioned, the risk of anti-forestalling provisions coming into place. And also, there is a view that to the extent something radical is introduced, there could be some sort of relief mechanism or rebasing mechanism that is introduced. So I think certainly the more kind of, steps specifically from a tax perspective to uplift on base costs are being considered, but not necessarily actively being pursued at this stage. But certainly steps, and including not just on capital gains, but on inheritance tax as well. So maximizing reliefs, so making the most of nil rate band, making the most of gifts out of available income. For instance, concerns about possibly BPR no longer being available. So if they're transferring BPR assets into trusts, all of those things are being more actively considered when they were perhaps previously being put to a back burner, and that's the kind of strategy which is being adopted by most clients at the moment. If we get more speculation, then who knows? But I think one interesting thing and one thought that we've been discussing is whether any kind of tax increases could be a way to influence behavior more generally. And by that, I mean, the interesting thing about capital gains tax is obviously, in many cases, it's a tax which you have control over, because you can set the time in which when a disposal event occurs. Yeah. And so whether the Chancellor could actually consider setting a later date for an increase so as to encourage more disposals to happen, so to generate revenue that way. So rather than there being this cliff event of an increase in capital gains tax, say on the date of an announcement, actually having it introduced from the start of the tax year on the basis that you hopefully generate revenue, albeit being at a lower tax rate than it would have been at the increased rate.
That's quite interesting. That's almost kind of saying anti-forestalling rules are not going to be put in place, and let's just get them taxed and let's get the revenue in for the Treasury.
Yeah, but I think the risk you have there is that a lot of people anticipate any CGT rise as being a temporary measure. Yeah. And so it'll be a question about, well, can we hold out for, say, 2 years, 3 years? I mean, there's some suggesting that, the Chancellor would be minded to try and reduce the rates in the run-up to an election as a bit of a vote thinner. And so those who take that viewpoint obviously are not going to be helping generate revenue, because they'll just defer the date on which they would be trying to carry out a disposal. Of course, there'll be those who have to carry out disposals naturally as a part of their event life cycle. But for many, is it really going to provide the revenue generation that they're anticipating?
Because we're seeing quite a lot of buy-to-lets being sold at the moment in the market. Is one, to crystallise the capital gain at the rates they're on now, and also the reliefs have dropped off in the last 6 months. As we were discussing earlier on, property values have gone up, so they're slightly inflated at the moment, so they can generate that additional return and pay less taxes as a combination of the two. But the other thing that we looked at from a CGT point of view was the effect it will have on beneficiaries, whether it's stockpile gains in the offshore trust world. So, Mark, are you having similar conversations with beneficiaries who are based in the UK about paying out and distributing some of these gains while the rates are where they are? Because you could face, if it's a realignment between CGT and income tax, you could end up with a 72% tax charge with a supplementary charge.
Sure. Well, let me just kind of go back to something Kunal was saying around succession planning. So I guess similar to what Kunal was mentioning, we've had quite a lot of clients who, presumably because they've had more time on their hands and there's the COVID's out there and there's kind of more mortality has been thought about more readily. There's really kind of accelerated some of the plans around kind of how the structures that we look after are, whether they're effective, whether they're kind of set up correctly to then kind of shift on to the next generation. So there's been quite a lot of work around that with the advisors that work on those structures. So that's really kind of accelerated some of that thinking. And I guess with potential tax changes being mooted, that's very much on the radar. I think the difficulty is the uncertainty around it. So some clients are a little more reticent to push the button on it because they don't know, they're not sure exactly what we're dealing with. So I think there's a kind of piece of work around kind of optimizing what we've currently got. There's impact of potential sales which were on track pre-COVID, which now are impacted by the industries they're in. So let's take retail centres. The price you get for a retail centre now versus what you would have done pre-COVID is completely changed. We've got university accommodation, which was being looked at for sale now. That's kind of dependent on whether you can keep the students in the accommodation. So there's other factors that are kind of coming into play as well. But certainly I think we're staying close to our advisors, and this isn't just the UK. So we've got a case where there's a Canadian resident who looks like he'll probably accelerate some distributions out of the structure, just because it would be it's better to lock in at the current rates in Canada. So I think it's very much a case by case basis, but equally it's and it also depends a little bit on the kind of underlying kind of beneficiaries' kind of appetite around where they think things are going, and what the advisor's view is on where tax rates will go. So it's not kind of straightforward, but I think we're kind of ready to move.
But isn't that even more important, the reason why we're having these constant conversations with beneficiaries and settlors?
Yeah.
Is really important to guide them through that process, because as advisors we're struggling to get our head around most of these changes and what they mean and what the impact can be. That process of guiding the client through it is, I think, very critical. And I think one of the things we've noticed, the increasing amount of time we've had to spend with clients, but because we can use Teams and we can use Zoom, it's made it so much easier because you don't have to travel around. So it's much easier to have those quick meetings and those quick calls. But Stuart, you must have had endless calls.
Yeah, lots of different discussions being had with clients, not just on investment side, but on taxation and so on. And again, all I can say on that is that from a sort of macro level, the hole in the finances is almost too big to properly comprehend. I'd be very surprised if they move quickly to a fiscal austerity footing, and especially in certain localities where there's elections to be fought and won and lost. And there's one more thing from a pure investment point of view is there is a relatively new school of thought coming out of the US supporting a theory. It's called modern monetary theory, MMT. Other people might call it modern monetary finance or magical monetary tree. And this basically is where the different arms of governments work much more closely together, i.e. the central banks would be open to financing government spending in some way. We've seen this already in the UK, where the Bank of England extended an overdraft to the government. And we see central bankers in certainly Europe and US pleading for politicians to do more on the fiscal side to overcome the current challenges. And they stand ready to finance a lot of government debt issuance, if not directly, then certainly via quantitative easing programs. And they're going to keep interest rates low whilst they try and effectively get the economy back on the footing. So what this means to me is and also one of the impacts of years of quantitative easing is that debt levels, certainly the government and corporate, less so the household, but debt levels globally are at gargantuan levels. And back to this sort of war footing that has been mentioned a couple of times. Historically, when we get to this sort of level of debt, there's no easy way out. And government, politicians and central bankers will not want to go through a process, the hard process of writing debt off and so on. The much easier path of trying to overcome the current debt problem without a very difficult economic outcome, or certainly sort of, from a deflationary point of view, is to try and inflate this debt away. And that is clear to me that they're now on a path of trying to inflate the debt away. And I suspect that they'll just have to accept that they won't be balancing the books in terms of zero annual deficits for a very long period of time. But as long as they can have government deficits below the nominal rate of growth in the economy, nominal being real and inflation, then they might be able to get through this as they did post-World War II. But investors have to realise this is going to mean a lot of they need to really focus on what works in that potential economic environment with their asset allocation. And financial repression is a very, very difficult way or environment for which to sort of manage money from a macro perspective, and it's all about opportunities and managing the threats.
Thanks, Stuart. Everyone seems to have forgotten about Brexit. What does it actually mean? What impact is it going to have? Guy, you've obviously got family offices that are in Europe. Are they thinking about Brexit? Do they care about Brexit, or do they just carry on as business as usual?
Well, it's a good question. I think we tend to try and stay off the subject as much as possible at the moment for obvious reasons. But looking at life, I think it's very variable. Going back to what I said earlier, family offices are all different. They all have different businesses, different business interests. I think stepping back a bit for people, it's been a tremendous period of challenge. We've had Brexit, we've had COVID. It's been a hugely disruptive period for people. And I think people have found it very difficult to see certainty, to see clarity. I think from an investment perspective, it's been hugely hard to really understand what value is. Because if you're looking to seismic disruption to your earnings stream, valuation just becomes an impossibility. If there is no E, what is the P? So I think people have faced a lot of problems. I think more generally at the moment, whether it's the impact of Brexit, it's the impact of taxation changes here in the UK or elsewhere, I think people need to focus on the small stuff as well as, it's not necessarily about, do I sell that factory? Do I buy that building? Do I invest in tech? I think people need to really focus on the minutiae as well. Are all their filings correct? Have they done the small stuff? From an investment perspective, again, simple things like EIS. That's a 2 million tax benefit for CGT, income tax, and IHT. And if you're a non-dom, you can use BIR to achieve that. So I think, there are cumulative small things that people can focus on right now that look quite sensible without getting too embroiled into some of the bigger uncertainties.
Thanks, Kai. But what I would like to do is give you all an opportunity to say where you think everything's going, where your business is going, what do you see the next 6 to 12 months? What do you see as the challenges? What do you see as the opportunities? So Stuart, shall I start with you?
Sure. From a business point of view, just merged with Smith & Williamson, and we're private equity owned, so I can be very clear that our strategy is growth and growth and growth. In terms of, we're very private client focused. Our background has always been to try and deliver a hugely sort of positive service for clients. So it's not just the investment side, but I think Guy is absolutely right. Some of the minutiae is we like to think that that's taken as read that people are doing it, but actually to remind them that they need to do this in the current time period, I think is crucial for advisors to be close to their clients on that front as well. In terms of really how we're sort of speaking to our clients, as I said near the beginning, we're not sure. We have to be positioned for as many economic and market scenarios as we can. And of course, when you start putting a bit into your portfolios, the risk is that some sort of deflationary event. So we're trying to make sure that we're not in assets which could be hurt in the next year or two if we have a downturn in the economy again and policymakers make some, in hindsight or even foresight, some poor policy decisions. But really coming out of this, it's a bit of inflation proofing in client portfolios. Guy mentioned infrastructure earlier, and we've definitely been putting money into some infrastructure opportunities in the last year or so, and continue to do that, looking for projects where there's a legal link to inflation in the pricing of projects, maybe with annual upward only linkage to RPI in the cash flows of a project. Seems like a great idea to me, in a world where we don't expect outright deflation in the real economy. One thing we've been looking at a lot, and I think even Mark mentioned this earlier, was gold. And gold is a great long-term store of value and tends to do very well when inflation is moving a little bit higher and when real interest rates are negative, and also when there's less was fewer competing assets. And the reason I mention competing assets is when interest rates are zero and government bonds are close to zero, they don't compete with gold in terms of offering a yield, and gold doesn't offer a yield, but does have that 5,000-year history of being a great store of value, and I think that will remain the case in the future.
Colonel, do you want to go next?
I mean, I think for us, and has been the case since really the start of all of this back in March, is just to continue to support our clients through, the upheaval that they're facing, whether it be COVID related, whether it be Brexit, whether it be because of changes to financial markets. It's just to continue supporting them along the way of all the various issues that they come across. I think in terms of how we go about doing this, certainly the discussions I've been having over the last month or so is just general preparation and proactiveness. So reviewing existing arrangements, thinking about how to make things more robust, touching on a point that Guy made about the smaller detail, the minutiae detail, making sure that you're really fine-tuning arrangements that you already have in place. If you're fortunate enough to have those arrangements in place, those who perhaps weren't so proactive previously, try to encourage them to be a bit more so now, knowing that actually, the next 3, 4, 5 years could be considerably turbulent, and having systems and processes in place to deal with it in the best way possible, and just to equip them in the best way possible to deal with that, would make them be in a much better position at the end of it, hopefully. A couple of things that we didn't touch on, which I think are kind of reoccurring themes, is just generally HMRC are being much more aggressive as part of their general issues about increasing the tax intake, and again making sure that clients' affairs are in a position to deal in the best way possible with any inquiries that they might face over the next couple of years. And linked to that is also an important thing, which is not necessarily tax related, but generally a big concern for clients in the high net worth space, but is privacy. With increased information exchange, clients are increasingly being concerned, not because of sensitivities about their tax affairs, but sensitivity about the data that might be transferred to perhaps unscrupulous people who might decide to use it at an advantage to their detriment. And so increasingly, we found a number of clients in other jurisdictions where they might feel less comfortable with data being available to governments, actually looking to move to the UK because it's considered a much more robust jurisdiction from a perspective of handling sensitive data. And linked to that is also just making sure there's consistency in the reporting, so that family members know that they're not necessarily having information saying one thing to one party being completely contradictory to information that's given to another. And maintaining that consistency, again, is it going back to the first point about the having processes in place. It all links to that. So it's effectively preparation and keeping it, getting yourself best equipped as possible to deal with the years ahead.
That's quite interesting, Kunal, because one of the things that we were talking about yesterday with some of my colleagues was there's one thing putting some really sophisticated tax advice or giving sophisticated tax advice, but it's another thing actually implementing and make sure that it's implemented properly and the tax return is filed in accordance with that.
Yeah.
And people tend to forget that bit.
Yeah.
So it's important to make sure those two are dovetailed, so the story is straight to the revenue, because that's when the revenue will start inquiring into affairs unnecessarily.
Absolutely, that's right.
Mark?
Yeah, the offshore trust side. So I think there's a couple of themes thinking about the opportunities. First of all, uncertainty and clients having, and prospective clients having more time on their hands. I think that kind of plays quite nicely into the people either wanting to do something further with their existing structure or indeed set up a new structure, and being at a firm now which has a kind of wider network and a wider jurisdictional choice, I think plays nicely into our hands from a private client perspective. I guess where I am, we've seen kind of clients taking a little longer in terms of setting up structures generally. One thing that kind of I would say on challenges, how long are we going to be in a position where most of our meetings are virtually. So will that kind of be an inhibitor in terms of clients who maybe want to kind of go and actually meet you physically? The trust world over the last 5-10 years is kind of it's moved away from not just kind of the kind of gravy train to kind of London to pick up files. There's been more kind of international focus, and will that have an impact, or will people adjust to the virtual world, or will we kind of hopefully kind of we'll get a vaccine quicker than expected, and we'll kind of there's some normality will resume. But as things stand, we're having kind of calls with people out in the Far East, and that seems to work quite well. But I kind of have that kind of query in my mind as to whether that's going to be a kind of challenge we're going to have to face, or whether the world will adapt, and the kind of need to have a structure will override the kind of need to actually kind of meet some of these people actually physically. So I think that's the kind of things that come out from my initial thoughts around that.
I think we're going to find that you can't actually replace face-to-face in any way, shape, or form.
Yeah, and trust as trustees, it's very much a kind of people business, and
Absolutely.
It's about kind of meeting your kind of set your beneficiaries in person, and getting to know what the drivers are for them, what their objectives are for the structure, and that's fine in cases where we already have that relationship and you're kind of meeting people. And in fact, we'll probably have more of these video calls with our clients than phone calls now. So it's almost a bit of a shock when you get the phone ringing. So it's a kind of pre-arranged video call now. So you are kind of almost getting to see them virtually more often than you would have done. Yeah, I think I agree with you. I think it's a people business, and nothing substitutes those in-person meetings.
Ollie?
I'll pick up on the point you and Mark were just mentioning. I mean, obviously, Mark, Maria, and I are still trying to build a business, and trying to pitch to people when you haven't met them before is pretty difficult. And I would say, my USP is, the business development side is actually meeting people in the flesh, building relationships, having coffees, having drinks, having lunches, networking events, and I think those are going to be certainly difficult over the next 3 to 6 months for sure. But I really hope and believe that if we can get back to meeting in person, I know people are keen to do so. I know intermediaries I'm getting hold of, and prospects and potential clients are keen to meet in sort of COVID secure areas, and whether that's just outside or whether that's in restaurants or cafes that you're allowed to sit down and eat and drink without masks and that. But I still think that building relationships is absolutely key, and you can only do so much on these calls, on these video calls. I mean, I would say that going back to what we're trying to do at EFG, we're obviously trying to build a business. We've only been there just over a year now, and we want to be the private banking partner of choice, not just for ultra high net worths, but for family offices and trustees. And I would not only the people on this call, but I'm reaching out to people to find out, what are the services that they're getting from current banks that are good or are bad, and what's missing. What do they want from their current private banking provider? What would you like more of, or what would you like less of? These are the sort of questions I'm posing, and I think we're in an institution now where we can be that private banking partner of choice. Mark, Maria, and I have worked together for 13, 14 years. We're a close-knit team. We've got the knowledge, we've got the tools, and we're looking to grow. So, it's an exciting time, but it's a difficult time. And I think, as you said, we've just got to evolve, adapt, and find ways to get in front of more prospects. And this initiative is only at the start of it. So many thanks, Rags.
I think we can also say we've all got a bit of grey hair. We've been through some bad times, but each bad time provides us all an opportunity and to learn from it as well, more importantly, and guide clients through it. So I think it's really key. Guy, any final comments for you?
Yes, Rakesh, thank you. I must admit, actually, quite a lot of people keep telling me they're looking forward to having a drink with me again, which probably says something about the company I keep. But I think just to sort of summarise, I've got sort of 3 key points that I'd like to mention. I think, firstly, just broadly for people looking at deals and investments, 3 key buckets: value, growth, and risk. Those metrics have all changed. I think in the risk bucket, things to do with potential government intervention are now far more serious than they might have been. Licenses, that sort of thing, going back to Brexit. So I just flag those for people going back to what I said earlier, look at the small stuff. Kaizen planning, lots of small steps might actually get you to a better place than trying to execute one particular large transaction or planning exercise. And then I'd just like to finish, I think, by saying that for several reasons, UK tech off-market companies are a really interesting focus at the moment. Yeah, I'm saying that because I have an association with Committed Capital, the VC manager. But I think for investors, one thing I would say, waving the Union Jack here, these companies are very badly served by British capital markets. So I think there's an opportunity for some good investment here for people, but I think there's a great opportunity for people to help British companies too.
Thank you, Guy. And thank you all for participating in the inaugural roundtable. I hope you all enjoyed it. And thank you again, and we look forward to seeing you guys on a future one.